September 2025. The world is watching America's central bank. The Federal Reserve may cut interest rates, but instead of calm, there's a storm. President Trump has tried to fire a sitting Fed governor. A lawsuit filed by Governor Cook is challenging whether the president has the authority to fire a Federal Reserve governor without sufficient cause. A legal battle that tests the limits of presidential power over monetary policy. Jerome Powell, the Fed's chair, mocked as "Too Late Jay," faces relentless pressure, and global leaders warn that U.S. politics could destabilize the world economy. It feels unprecedented, but history shows the Fed has weathered storms before. From the Great Depression to the runaway inflation of the 1970s, from the collapse of 2008 to the pandemic of 2020, the central bank's playbook has been rewritten again and again. The question today is the same one history has asked for over a century. Can the Fed remain independent, or will politics finally take control of America's money? The Federal Reserve was designed to be independent, shielded from the short-term incentives of politics, so it could make the tough calls politicians often avoid. Its mandate: keep prices stable, promote maximum employment, and safeguard the financial system. But independence only works if presidents and Congress respect it. Today, that line is under attack. On August 25, 2025, President Trump announced on Truth Social that Fed Governor Lisa Cook was terminated effective immediately. It was the first time in 112 years that a president had tried to remove a sitting governor. 3 days later, on August 28th, Cook sued the president and the Board of Governors. On August 29th, Judge Gia Cobb heard arguments for a temporary restraining order in a case that is widely considered to be destined for the Supreme Court. The outcome could decide whether presidents can purge the Fed at will. Meanwhile, Trump derides Powell as "Too Late Jay." He demands rates slashed to 1%, blames the Fed for trillions in interest costs, and even threatens lawsuits over Fed building renovations, which are estimated to cost $2.5 billion. Markets are jittery. Traders bet on a September rate cut with 87% certainty. Inflation sits at 2.7%, above the Fed's 2% target. The U.S. dollar wobbles. Abroad, ECB President Christine Lagarde warns that undermining the Fed is a very serious danger to the world economy. For decades, Fed independence was considered sacred. Now, for the first time since its founding, it's on trial. The Fed's story begins in fear and chaos. In 1907, a failed copper scheme triggered bank runs. Depositors lined up outside failing banks. Newspapers stoked panic. With no central bank, there was no referee. Instead, one man stepped in. J.P. Morgan convened the nation's top bankers in his library until they agreed to a private bailout package of approximately $30 million, a rescue effort that was supplemented by a separate $25 million from the U.S. Treasury. The panic subsided, but Americans were shaken. How could the richest nation on earth depend on one man's fortune to save its economy? In 1910, Senator Nelson Aldrich convened a secret meeting at Jekyll Island. Attendees traveled under aliases, claiming to hunt ducks. Behind closed doors, they drafted the blueprint for a new central bank. 3 years later, on December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act, a Washington board appointed by the president, plus 12 regional reserve banks. Its mission: provide an elastic currency, act as lender of last resort, and stabilize finance. From the start, critics bristled. To some, it was a banker's conspiracy. To others, dangerous government power. That mistrust never disappeared. The Fed's first test came in the 1930s. When the stock market crashed in 1929, panic spread. By 1933, nearly 1/5 of U.S. banks had failed. Families lost life savings, businesses shuttered, Instead of flooding credit, the Fed hesitated. As a result, the money stock fell by 33% from 1929 to 1933. Unemployment hit 25%. Bread lines stretched for blocks. Hoovervilles dotted city parks. Former Fed Chairman Ben Bernanke, acknowledging the institution's errors, famously stated in a 2002 speech regarding the Great Depression, "You're right, we did it. We're very sorry. But thanks to you, we won't do it again." Roosevelt declared a bank holiday, closing every bank until inspectors cleared them. The FDIC was born to ensure deposits. Glass-Steagall separated banking functions. The Fed itself was restructured to be more centralized. The lesson was seared into its DNA. In a crisis, doing nothing is catastrophic. During World War II, the Fed capped rates to finance debt. For nearly a decade, it maintained the peg. By the late 1940s, inflation soared. A bitter fight followed. Treasury wanted cheap financing for the Korean War. The Fed argued stability mattered more. In 1951, the showdown ended with the Treasury-Fed Accord. The Fed regained independence to set rates without political permission. Chair William McChesney Martin captured the principle in a 1955 speech, stating, "The Federal Reserve is in the position of the chaperone who has ordered the punch bowl removed just when the party was really warming up." The metaphor was not widely known at the time, but gained immense popularity in the 1980s, becoming a key narrative tool for explaining the Fed's unpopular but necessary anti-inflationary actions under Paul Volcker. It wasn't just a technical shift. It was a declaration that the Fed would serve long-term stability, not political convenience. But independence on paper isn't always independence in practice. In the 1960s, Lyndon Johnson leaned heavily on Martin. At his Texas ranch, he grabbed him by the lapels, shouting, "Boys are dying in Vietnam, and Bill Martin doesn't care." Martin resisted, but the Fed often compromised. Inflation crept upward. Then came Richard Nixon. Facing re-election in 1972, Nixon pressured Fed Chair Arthur Burns. On the White House tapes, Nixon pressured Burns, stating that his re-election in 1972 depended on a low interest rate environment. Burns eventually capitulated, keeping rates low and contributing to a surge in inflation after the election. Burns caved. Rates stayed low. Nixon won in a landslide. Inflation surged into double digits. By the late 1970s, stagflation, high unemployment, and high inflation broke public trust. Grocery bills doubled, wages lagged, mortgages soared. The Fed's credibility collapsed. In 1979, Paul Volcker became Fed chair. Inflation was spiraling, and Americans had lost faith. Volcker acted boldly. He targeted money supply, letting rates soar. By June 1981, the federal funds rate peaked near 20%. The pain was immense. Unemployment hit 10.8% in 1982. Housing collapsed. Farmers drove tractors to blockade the Federal Reserve. Protesters rallied nationwide, but Volcker held firm. By 1983, inflation had fallen below 4%. It stayed low for decades. The lesson was costly, but clear. Independence sometimes requires short-term pain for long-term stability. Volcker's stand restored credibility not only for the Fed, but for the dollar itself. In 2008, a housing bubble burst. Subprime mortgages collapsed, major banks teetered, Lehman Brothers failed, credit froze, panic spread globally. This time, the Fed moved fast. Under Chair Ben Bernanke, rates fell to near zero. The Fed opened emergency facilities, lending trillions. It coordinated with foreign central banks through dollar swap lines. Then came quantitative easing, QE. The Fed created money electronically to buy bonds. Its balance sheet exploded from under $1 trillion to over $4 trillion. Critics said it bailed out Wall Street. Protesters filled streets under the banner "Occupy Wall Street." Supporters argued it prevented another depression. Either way, the Fed's powers expanded permanently. In March 2020, COVID froze economies overnight. Tens of millions filed for unemployment. At its peak, U.S. unemployment hit 14.7%. The Fed cut rates to zero. It bought $700 billion in bonds in weeks. It backstopped corporate credit, municipal bonds, and small business loans. For the first time, fiscal and monetary policy moved in tandem. Congress passed the $2.2 trillion CARES Act, sending checks to households. Treasury and the Federal Reserve launched joint lending programs. Markets stabilized. Collapse was avoided, but the side effects were serious. Supply shocks and stimulus fueled the inflation rebound of 2021 to 2022. By 2023, the Fed was raising rates aggressively. And now, 2025, Trump rails against Powell, mocking him as "too late Jay." He demands cuts to 1%. He claims the Fed has cost America trillions. On August 25th, Trump moved to fire Lisa Cook. On August 28th, she sued. The case is heading to the Supreme Court. ECB President Christine Lagarde warns political control of U.S. monetary policy poses a very serious danger. Olli Rehn calls Fed independence an inviolable principle since the 1980s. Markets tremble, the dollar weakens, lenders reassess risk. For the first time in modern history, the world wonders if the Fed can resist political control. Myth 1. The Fed prints money. Fact: the Treasury prints dollars. The Fed manages credit and liquidity. Myth 2. The Fed is a private cartel. Fact: governors are presidential appointees, confirmed by the Senate. Profits flow back to the Treasury. Myth 3. The Fed always gets it right. Fact: from the Depression to the 1970s, the Fed often learned through failure. Why does this matter for you? Because Fed decisions ripple into everyday life. A cut lowers mortgages and credit card bills, but can fuel inflation. A hike curbs inflation, but risks jobs. Political interference can raise borrowing costs for everyone by undermining trust in the dollar. History offers warnings. In Turkey, political meddling has coincided with periods of extremely high inflation. In Argentina, frequent changes in central bank leadership have occurred alongside periods of spiraling prices, with July 2025 year-over-year inflation at 36.6%. The pattern is clear. Politicized central banks lose credibility and citizens pay the price. The Fed is not just a bank for banks, it is the referee of the U.S. economy. When its credibility holds, markets trust American money. When it wavers, everyone feels the tremors. History offers lessons. Protect independence. Volcker proved credibility requires defiance. Increase transparency. Since the 1990s, communication has anchored expectations. Balance accountability. Congress should oversee, not dictate. Reform ideas. GDP targeting, fiscal debt breaks. Others argue flexibility is the Fed's greatest strength. There is no single formula, but trust remains the constant. The Federal Reserve touches every paycheck, every loan, every retirement plan. For more than a century, it has swung between independence and pressure, caution and boldness. Today's drama is just the latest chapter. The question isn't whether the Fed will face storms. It always has. The question is whether America still believes in an independent referee for its economy. History suggests that when the Fed holds firm, the nation weathers the storm. The real test is whether it can do so again. If this video gave you a new perspective on the Federal Reserve, subscribe to History That Matters. Share your thoughts in the comments. Should the Fed stay independent, or should elected leaders have more say in the cost of money?